Hi everybody. Today I'm going to talk about buy and hold, why it's a pretty good strategy over the long term, especially for passive investors, what it is exactly, and then I'm going to talk about what my largest buy and hold portfolio is and how it's broken up into different positions. Of course, at the end, I'll talk about a little bit of jelly. That's something I enjoyed outside of the markets. Welcome to the Portfolio Bulletin. Let's get started. Let's talk about what buy and hold is. So buying and holding for a long-term passive investment strategy. So in the beginning, you decide what companies you like if you're going to invest in individual shares, or what indexes you're going to buy if you want to buy the whole market and you don't want to do research into individual companies, or just that you want to diversify across a lot of companies. So you can either buy some stocks or some indexes or both. And you're essentially picking those companies and continuing to funnel money into those positions. So the buy and hold strategy is a long-term strategy, and it's pretty simple. So buy and hold strategy refers to the investment strategy of investors where they buy and invest in securities for a long time with no intentions to sell in a short period. And it refers to investments for a long period of time by retaining the investment, usually ignoring the ups and downs of market price over the short term. So what does this mean? Basically, as I said, you pick what you like, pick various indexes or individual stocks, and you just funnel money into those positions until you're ready to retire, ignoring generally market direction. You don't have to completely ignore it. If you see that the market is at all-time highs, you could slow your investing. If you see that the market is dipping or is off its highs like it is right now, you could increase the amount of money that you're putting into the position, and that's just going to help you dollar cost average into that position. So it's not completely passive. It can be. It's up to you really how you want to do it. If you just continue to put in money at a regular pace, is really the simplest and most passive way to buy and hold. So let's talk about some of the problems with buy and hold. So the run up to the dot-com bubble here in the summer of 2000, you can see the market. This is the SPY. So the S&P 500 would have been around 1500. And then we had a dip right here in the 2003 bottom-ish. And that was about half the value. You can see here you could have bought in at the lows at about $85. Really, you could have got in probably about a 50% drop there. And then we ran all the way back up to meet those highs again in 2007. We met the highs from 2000. And then we ran all the way back down more than 50% in the 2008 crisis. So then here you can see we continued our run up from those lows where we had the bull market and then the highs in February of 2020 up to 33.7. So had a nice bull run. This is the longest bull run in history. And then we had the dip right here in March. So if you go back to here, you can see that the buy and hold strategy basically produced nothing from the end of 2000, the summer of 2000, until we got right back here to March of 2013. If you had put in no additional money during this period, the money that you put in at the high in 2000 did not grow in value until March of 2013. So there are some proponents that suggest that you should trade this market. When you have sideways motion like this, the only way to really make money is to trade or continuously pump money into this position. As you continue to pump money in, that's going to reduce your average cost of the position. Then once the market starts to recover, then the lower dollar cost of those positions will increase at a faster rate. Of course, it's always a good idea to continue to invest because the market tends to grow over time despite this little downturn. All right, so let's move on to my largest holding. So this is the TSP homepage. You can see it breaks down all of the different funds, and they're all managed by BlackRock. They were contracted by the federal government to manage these funds for government employees. The G fund is all government securities. You can see here the F fund is a bond index. Common stock is the S&P 500. Small cap funds is designed to mirror the Dow Jones Total Stock Market Fund. And then the I fund is international stocks. And the L2050 fund is a blend of all of these that I will cover later. And it changes every month based on how many months you have until retirement. Going further down, you can see my current allocation. This is where all of my money is by percentage. It's really showing the same thing as up here, but it's showing it by a percentage basis. And then over here, you can see how I'm currently allocating funds. So as a young person, I should be more invested in stocks and a little bit less invested in government securities. So I saw that I had 9% overall in government securities right now. Plus I know that there are some government securities in the L2050 fund that I will cover later. And I felt that that was a little bit high, especially with the recent market dip. So once the market started dipping, I started increasing the amount of money that I was putting directly into the C fund. So as the market declined, I was buying shares at a cheaper and cheaper price. I still am buying some small cap funds. And maybe I'll increase that once we see a little bit more about how the coronavirus is going to affect small cap stocks. Small businesses are definitely going to be more affected by this situation than large cap. So I am buying a lot of large cap stocks in the S&P 500, and I have slowed the amount of purchasing I'm doing in small cap for now. Once we see how this is going to pan out, I might increase this a little bit later, but right now I'm just trying to get my exposure to the S&P 500 up. This page also does not break up the amount of money in each of these funds by Roth or 401k. Some of these funds are matching, which I'll explain later, but this is all of the money that I have invested, and that includes what was given to me by the government for matching and what was paid out of my paycheck. All of the funds that came out of my paycheck are going into a Roth IRA, so they will be withdrawn tax-free, and all of the matching retirement pay goes into a 401k so that it can be taxed upon withdrawal. Recent transactions section shows exactly where the money is coming from. You can see here the 292 is my matching. So the government right now, if you opt into it, has a 1% automatic deposit, 1% of your base pay, and then a matching. So they will match up to 5% of your contributions. So at a minimum, if you work for the government and you have the option, you should deposit at least 5%. Of course, this is up to you, and you should consult your financial advisor to see if that's the right decision for you. However, this is essentially free money that the government is willing to invest on your behalf, as long as you invest 5% of your own money. So if we go up here, this is money that came directly out of my paycheck. It shows here I am depositing it into a Roth. So this is post-tax money, and I will withdraw it tax-free. And you can see here, this is exactly how it's being invested. If we go back to this is being invested in a traditional 401k, so it is pre-tax money, and that's because it is matching from the government, so it's not taxed as it's given to you, and if you are allowed to put it into a Roth, then it would be tax-free upon withdrawal. And of course, the government's not going to let you do that, so it must be placed into a 401k, therefore it can be taxed upon withdrawal. If we go here to the activity summary, you can see what I've deposited in the last month. I've put in $263 into the L fund, and then as it goes down the list, it shows exactly what dollar amount I've put into each of the given funds. And then this is the total for this month. The way that it's set up for me is that on the 2nd of every month, it comes right out of my paycheck and it goes straight into the markets. So on the 2nd of every month, this amount goes into these funds. So here's a list of all the different funds, and let's get into exactly what they look like and their returns. So the G fund, as I mentioned, is government securities. It's not going to lose money. It's really a protection against inflation, as it says here. Usually makes about 2% annually, but it does not decline in value, and this is where you put money. It's basically a savings account, a high yield savings account. This money is guaranteed and the value will not go down. However, the returns, of course, are going to be limited because of that. You can click here and go over to performance. And you can see here that monthly returns for the last 12 months less than 1/4%. And then annual returns for the last 9 years, you can see it ranged somewhere pretty close to 3% down to about 1.5%. As I mentioned, it's somewhere between 1.5% and 3%. So on average, you're getting around 2.25%. So that's basically keeping up with inflation. Not really much of an investment fund, but more of a savings account like you could get at any bank with a high yield savings account. If you go over here to the F fund, you can see it's designed to match the Barclays US Aggregate Bond Index. So you're going to get the same returns as the bond markets. The funds here, of course, are not any different really than you can invest on the civilian side with any normal broker. This is actually very similar to the Vanguard Aggregate Bond Fund. The ticker for that is BND, or the AGG Fund is another aggregate bond fund, which would be very similar to the ones available here. Going over to common stock, you can see it's designed to match the S&P 500. Nothing special here. Any S&P 500 is going to match the returns available here by the C fund. This is the S&P 500, and they compare it directly to the S&P 500. In 1 year, basically the same. 3 year, basically the same. 5 year, basically the same. So this is essentially identical to the makeup of the S&P 500 index, and you get the returns that you would expect. So in 2018, it was negative. In 2011, very flat. 2015, very flat. Last year, pretty good, right around that 33%. And then you can see here in the last few months, we've had this extreme downturn, and I'm experiencing that along with everybody else. And then going over to small cap stocks, you can see this is a broad market index, but it's primarily focused around the Dow Jones Total Stock Market Fund. And you can see small to mid cap stocks, and it provides additional diversification from the S&P 500. Again, pretty on par with what we've been seeing from the market as a whole. Some flat years, same flat years as usual, and some growth years, a little bit higher growth than the common stock fund on the highest end versus the common stock fund, but the consistency is not very good. So you can see if you had invested $100 in May of 2001, today that would be worth $516. And then the blue line here is inflation. They show what it would be worth just as an inflated number over that time. And then they actually compare it to the total stock market index, the Dow Jones Total Stock Market Index. And you can see pretty close to the total stock market. It actually outperforms a little bit more than some of the other funds, but generally it's on par with the total stock market fund. And then going to the I fund, the international fund, this is just going to be stocks that are not based in the United States. So you can see here, it's you can see here funds in Europe, Australasia, and the Far East index. This fund really hasn't had the best returns. Moving over to the iFund performance, you can see it's pretty choppy, and it's been in the downturn along with everything else, and it generally underperforms the market. It's had the least returns versus inflation. You can see the S fund, I said, would be about $530. This is only going to be about $249 in that same time. So the returns are a little bit less than the total stock market fund. And by a little bit less, I mean half. So the returns on the I fund are generally a little bit lower. And that's why the I fund is currently my lowest position by dollar value. So let's take a look at the L2050 fund. Currently, this is how the money is being distributed when you put money into the 2050 fund. Right here, you can see it's 40% the S&P 500. They still put about 10% into the G fund, which I mentioned was savings, 8% into the bond fund, and then 13% into the S fund. And then just a little bit goes into the I fund. Since for me, the L2050 fund is only about 25% of my overall portfolio, and then 28% of that goes into the I fund. The I fund is actually my smallest holding, but I still have a little bit in the I fund just for diversification purposes. For the life cycle funds, they do the returns a little bit differently. They show you how it's aggregated, as I already talked about, and then they show total returns. So overall, This fund was only started in 2011. Since these funds are based on when they expect people to be retiring, they start the funds around the time they think people who will start working will need this lifetime cycle fund. And this fund is for people retiring after 2045. It's pretty aggressive, and you can see here it's basically the same as the S&P 500 has been, a little bit less returns on the high end and a little bit softer dips on the low end. We're only down right now about 12% overall in the 2050 fund, and that's because there is such a significant amount in the G fund and the F fund. If you click here, you can see how it's going to change from month to month. So as we go forward, the G fund, let's say October of 2022, the G fund is now up about 1%. The F fund is a little bit lower, and the C fund is currently also increasing. The S fund is also decreasing, and the I fund is staying about the same. So as you continue to go forward, that trend continues, and then let's push it all the way out to, let's say, 2045, where you would be retiring. An extremely large portion is now going into the G fund, almost 34%. The F fund is decreased to almost 5%. And the C fund is still pretty high at almost 31%. S fund decreased because that's going to be the most risky. And then the I fund is a little bit higher than I would think at 21%. So you can see they're assuming less risk in the stock portfolio and putting more money into the G fund over time. And that is to reduce that volatility into the future as you're getting close to retirement. So how exactly is my portfolio broken down, and what has been the performance to date? So up here I have my current value, I have my value of the 2050 fund, and then I have my value of each of the different funds that I allocate myself, and then I aggregate them here, and then I represent them by percentage here. You can see here that the S&P 500 is my largest holding, almost 50% of this overall portfolio. The S fund is my second largest at 25%. Then I have government bonds here at 12%, which is a little bit higher than I would like, but it is what it is. And then corporate bonds at 8%, and then the international fund at 7%, which is my smallest holding, and that's because it really hasn't been a strong performer. But I do keep it just for diversification purposes. Then moving down here, you can see I break down by year my contributions, my end of year value, and then year over year growth. So this first year, I didn't really know exactly how this system worked. If you put money into TSP without allocating it, it will allocate 100% of your contributions to the G fund, which is why you see such a small growth number here. Also, I started contributing about halfway through this year, so that's why that number is so low. After that, I reallocated all of my funds, and I started seeing the normal growth numbers from the stock market. Of course, the highs are going to be a little bit lower. Here in 2019, I got 24.5%. And that's because I do hold some bonds, so just to reduce the volatility a little bit. And then you can see here in Q1 of 2020, I'm down about 9% for that quarter. And that's because I do hold those bonds. So my lows are a little bit higher and my highs are a little bit lower, just to reduce that volatility with the bonds. And then my total percentage growth is a little bit over 6%, and that's really decreased by that latest 9% drop overall. So what are the takeaways? You should diversify all of your money into various different types of assets: government securities, corporate bonds, the stock market being the S&P 500, total stock market funds, and some international funds. So the G fund, the equivalents that I could find are the IEF and TLH funds. Those are ETFs that you could encompass government securities. BND and AGG, as I already mentioned, for the F fund. For the C fund, VOO, which is the Vanguard S&P 500 fund, is the one that I would suggest. It does have the lowest management cost of any S&P 500 ETF that I'm aware of. For the S fund, it's more complicated. It's kind of a blend of the Russell 2000, the iShares Total Stock Market Fund, ITOT, or the Russell 3000. If I had to pick one, I would say maybe the Vanguard Total Stock Market Fund, which is VTI. That has the lowest cost to own in terms of fees. And then the I fund is most consistent with the EFA fund. So one thing that I do like about TSP is that the cost to own these funds is all very low. It's 0.04%, which is on par with most Vanguard funds, which sit around 0.04, or some funds like VOO sit at 0.03%. And those are some of the cheapest funds that you can find out there. And then you can simply use this percentage here to allocate your money, and then you would have the same portfolio as this. If I was a little bit younger, I would have put a little bit less in government bonds and a little bit more into the stock market. If I was a little bit older, I would put more in government bonds and more in corporate bonds and a little bit less in the stock market. I'd probably put about the same in the common stock market and a little bit less into small cap and less into the I stocks. The S&P 500 seems to be pretty stable over time, and it will grow over time. But the closer you get to retirement, you definitely need to be aware of a potential correction like we're experiencing right now. If you'll notice, I did add a 6th bullet point here, and this is what I think is really missing from TSP. They don't have any assets tied to real estate. So because of that, if I was outside of this framework of TSP, I would add a fund maybe like VNQ or VNQI. These are Vanguard Real Estate Funds, or SCHH, which is a Charles Schwab real estate fund. And then ticker symbol O is a REIT that I've already talked about on this channel that I also have been buying pretty significantly recently. And then another thing, go ahead and add it right now. Fundrise is another thing that I believe in quite heavily and is a pretty large portion of my overall portfolio. I will talk about Fundrise a little bit more in other videos, but Fundrise does have an ability to lock assets, so I wouldn't invest with Fundrise if you expect to need that money within 5 years. Of course, this is all my opinion, and you should consult your financial advisor before making any decisions. Talk to your broker, and of course, this is all for entertainment, so make your own decisions and choose your own destiny on that. All right, let's get to that jelly. The thing I enjoyed today is talks about the U.S. economy reopening. So people think that the economy might get started back here in May and June, and then we might have a bounce back. So Munchin, who is the Secretary of the Treasury, is feeling confident that the economy could open. And they say that a slow opening in May and then a continued opening in June could really send the economy into a V-shaped recovery, as they're showing here. I think that's a little optimistic. I think it'll be maybe a lazy V or a little bit more of an L and then an upward motion after that, just because of the heavy debt that we've taken on to get through this little Rona situation. However, I like the positive talks, and the positive talks will potentially raise the markets. So keep that in mind this week if you are trading. And that concludes this episode. So thank you very much for listening all the way through. Please like and subscribe if you like content like this, and have a great day.